Review of Accounting, Chapter 2, Lecture 1, Income. Financial statements tell a story. It's not like a castle in the sky or of elves or Cinderella's slipper, but they do give a story and a background of how businesses are performing, how it performed in the past, and how it most likely will perform in the future. Basic financial statements to remember, and this will be a test question at some point, is income statement, and below that is statement of retained earnings, which is a supplement to the income statement, but income statement is the primary statement that we use. Balance sheet is another financial statement, and the statement of cash flows. These three financial statements will be used in business, no matter which area you work in, constantly, and will constantly come up throughout the course because they really are the foundation of finance and accounting. Income statement. It's a device used to measure the profitability of a firm over a period of time. The biggest thing with this financial statement is it shows if your company is making money or not. A defined period of time typically could be a quarter, semi-annually, but it's usually used on an annual basis for most companies. It presents a stair-step, a progressive fashion to examine profit or loss after each type of expense item is deducted, basically showing what is your bottom line and are you profitable as a company. Parts of an income statement include sales and cost of goods sold. And sales minus your cost of goods sold is your gross profit. Gross profit minus your expenses is earnings before interest and taxes, also known as EBIT, or also referred to as operating income. We're talking about the language of finance. Different words can mean the same thing, such as EBIT and operating income are pretty much the same thing. EBIT minus interest is equal to earnings before taxes, and then earnings before taxes minus taxes gives you earnings after taxes, also known as our net income. Different resources for financial statements that you can use is Yahoo Finance, Google Finance, Morningstar. Next slide is the income statement example of Apple. And with all these sources, I'd recommend going out to check those websites itself. Could be useful to go in there to look up the ticker symbol for Apple, and it will actually pull up financial statements that you can view on your own. Be useful to know that and use that because it might be used in case studies later on this semester. This is an example of an income statement pulled off of Yahoo Finance of Apple. So you can see it has research and development, selling and general administrative expenses put on here, cost of revenue. So just a great example to look at in your spare time as you're studying throughout the course to see how they allocate different things. This isn't as thorough as if we were actually working at Apple and had a detailed income statement that they would provide, or to see an income statement on a end-of-year report, an annual report that they send out for all shareholders, but this is a pretty good idea of what you would need to know for this class. This is another example of an income statement that is provided from the book itself, showing sales, cost of goods sold, your gross profits, showing all the items that we covered earlier in an earlier slide to show how the expenses break down to find out what your earnings are for each individual category. Return to capital. The three primary sources of capital that a company uses in order to raise capital for itself. Bondholders, as in that'll issue bonds, which is debt that the company is sending out to have people purchase that they will pay payments to that person for giving them money up front. Preferred stockholders are stockholders that receive dividend payments. Common stockholders also could receive dividend payments, but it's after preferred stockholders do. Earnings per share. It's interpreted in terms of number of outstanding shares, and it may be paid out dividends or retained by company for basically reinvestment in the company. So that's another measurement as far as capital is concerned, which we'll cover in the intro and analysis slide on how to calculate that. Statement of retained earnings. It's a small summary statement that indicates the disposition of earnings with any adjustment to previously reported income or any restrictions on cash dividends. And here is an example of a statement of retained earnings. We won't focus a lot on this statement because the other statements are more important to know, but this is just an example if you had a question on. Some limitations of the income statement is income gained or lost during a given period is a function of verifiable transactions, and that is if they can verify that the transaction took place, and that's where they can show the gain or loss. If something was outside of that time frame and happened, say from January to February, if there was a huge loss there for some reason within a company, you can't show that from your previous income statement from the year before. So it doesn't really give shareholders maybe as up-to-date, clear picture on that. Flexibility in reporting transactions might result in differing measurements of income gained from similar events at the end of a time period. So the reporting can be really dependent on the measurement of the income gained and how that is put in an accounting perspective. So it could. That is end of Chapter 2, Lecture 1. Please see On Course Resources, Week 3 for the Chapter 2, Lecture 2.